You know him. Every family has one. He tracks 5 apps on his phone. He watches 2 business channels simultaneously. He has a system, some combination of moving averages, news headlines, and gut feeling that he has been refining for years. And at every family gathering, he will tell you with complete confidence that he knew the market was going to fall last October. But did he actually know? Almost certainly not. But he feels like he did. And that feeling, that warm, reassuring sense that you are in control of what happens to your money, is one of the most expensive feeling in investing. This is the illusion of control, and it is costing ordinary Indian investors far more than they realize. Here's what I want you to hold on to as you watch this video. The problem isn't overconfidence, it's anxiety dressed up as strategy. That distinction is what this episode is about, and it connects directly to the biology we have been building across this series. Let me give you two pictures. First picture, you are playing Antakshari at a wedding. You get a difficult letter. Say, shh. And after a moment of panic, your brain finds a song. You feel sharp. You feel ready. You feel in control of the game. Second picture, you are rolling a dice. You want a six. You blow on it. You shake it harder. You throw it with particular flick of the wrist. Deep down, you know the dice doesn't care, but you still do it because doing something, anything, feels better than accepting that the outcome is random. Here is the bridge. Markets are the dice. Most of us are blowing on them and calling it a strategy. Financial markets are moved by thousands of variables at once. Interest rate decisions in the US, monsoon pattern in Maharashtra, a geopolitical event in a country most of us can't find on a map, currency movements, global fund flows, etc. etc. No individual investor controls any of this. And yet, most investors behave as if their actions, checking their portfolio 17 times a day, switching funds based on last month's performance, are somehow steering the outcome. They are not. This is why this is topic 7. Everything we have covered about fear, cortisol, and pattern recognition leads here to the moment the anxious brain reaches for the feeling of control. Let me take you to your kitchen. Think of a good pressure cooker. You add the dal, you add water, you set the weight, you apply heat, and then you step away. You don't keep lifting the lid every 5 minutes to check if it's cooking. Because every time you lift the lid, you release pressure. You slow the process. You add time to something that was already working fine. Compounding in investing works exactly the same way. Every unnecessary intervention, every fund switch, every redemption triggered by a headline, every re entry after a panic exit is a lid being lifted. The heat is still there, the ingredients are still good, but you have released the pressure that was doing the work. Now think about the investor who checks his portfolio 17 times a day. He is not cooking anything. He is just lifting the lid over and over, wondering why the dal isn't there. The illusion of control tells him that checking is management. That activity is strategy. That movement is progress. It isn't. It never was. Here is why this happens, and it helps to understand the biology before trying to fight it. Your brain has a deep ancient need to establish cause and effect. If that bush moved yesterday before a predator appeared, remember it. Act next time. Pattern recognition kept human beings alive for 200,000 years. It is not a flaw, it is a feature. But in markets, this instinct becomes a liability. Your brain finds patterns in random data. It connects your action, say switching funds, to a subsequent outcome, the market going up, and it creates a false memory. I did that right. Over time, you build an entire personal mythology of your investing skill. A mythology that is, at its core, a story your brain told you to reduce anxiety. We talked about cortisol in topic 6, how stress hormones physically hijack your prefrontal cortex under market pressure. The illusion of control is what happens when that hijack is complete. The amygdala is running the show and it insists on doing something, anything. The research is clear. Investors who trade more frequently don't outperform those who trade less. They underperform consistently across markets. The feeling of control is real. The control itself is not. Let's put a number on this. Two investors. Both start with 10 lakh rupees in a diversified equity mutual fund in 2014. Both earn the same underlying fund returns over 10 years. Investor A checks his portfolio once a quarter, rebalances once a year. He makes only 3 or 4 decisions in an entire decade. Investor B checks his portfolio daily. He switches funds twice a year based on star ratings and recent performances. He moves money out every time there is a correction, into gold or FDs, and back in when things stabilize. Investor A earns something close to the actual fund return. Call it 12% CAGR. His 10 lakhs becomes approximately 31 lakh rupees. Investor B, because of entry exit costs, short-term capital gain tax at 20% for equity held under a year, and the eternal human habit of buying high and selling low, earns perhaps 7 to 8% CAGR. His 10 lakhs become approximately 20 to 22 lakh rupees. Same fund, same decade, 9 lakh rupees difference. That gap is not bad luck. That gap is the cost of illusion of control, the price of all those active decisions. This bias doesn't live only in equity markets. You will find it in every asset class. In real estate, investors believe they can time property purchases to perfection, buying just before a locality appreciates, selling just before the prices flatten. But Indian real estate cycles are long, illiquid, and driven by policy decisions, RERA changes, GST on under construction properties, infrastructure announcements that no individual can predict. The real returns on residential property after maintenance cost, stamp duty, brokerage, vacancy periods, and inflation are often far lower than the headline sale price suggests. What did the illusion of control cost here? Years of effort spent managing a decision that was mostly outside the investor's hand. In gold, investors jump in when the headline screams about global uncertainty and step out when the equity looks attractive. But gold's price is driven by global central bank behavior, the dollar index, and inflation expectations across major economies. Your entry and exit timing adds very little signal and a lot of noise. In debt mutual funds, the illusion shows up as excessive switching between categories, liquid to short duration to dynamic bond based on interest rate predictions. Even professional economists get rate cycle predictions wrong with remarkable consistency. The individual investor doing it on the basis of a business news headline is not managing risk. He is manufacturing that risk. So if most of what happens in market is outside your control, what's actually inside it? 5 things. Only 5 things. 1. Your asset allocation. How much goes into equity, debt, gold, and real estate? That is your decision. 2. Your savings rate. How much you invest every month. This is the single highest leverage variable in long-term wealth creation. Far more powerful than picking the right fund or timing the right entry. 3. Your cost structure. Direct plans over regular plans. Low expense ratios. Minimal unnecessary churn. 4. Your behavior during drawdowns. You can't control whether the market falls 30%. You can control whether you sell in panic or hold on to your position. 5. Your review frequency. Decide in advance. Quarterly is sufficient for most long-term investors. Then close the app and live your life. These 5 things compound in your favor. Everything else is noise you are paying to consume. The antidote to the illusion of control is not passivity. It is directed action. Doing the things that are genuinely within your control and letting go of the things that are not. The investor who outperforms every decade is not the one who reacts fastest or reads the most. It is the one who builds a sound, rule-based system and then has the discipline not to interfere with it unnecessarily. Let me give you a practical framework. Start with your asset allocation. If you are newer to investing, the 100 minus age rule is a useful anchor. A 35-year-old keeps roughly 65% in equity and 35% in debt. A 55-year-old keeps 45% in equity. This formula does something powerful. It removes the recurring question of how much should I be in equity right now? That question, asked every quarter under the pressure of market noise, is a direct gateway to the illusion of control. The formula answers it once, and then you stop asking. Next, set your SIP and step away. Each automated investment removes one life decision from your cognitive budget every month. 5 SIPs means 5 fewer moments where your anxious brain can manufacture the illusion of control. Then define your rebalancing trigger in writing before the market moves. Something specific. If equity grows beyond 75% of my portfolio, I bring it back to 60. That trigger fires automatically based on math, not on headlines, not on cortisol. And finally, reduce your review frequency deliberately. Monthly at most, quarterly is better. Each time you don't check, you are not being irresponsible. You are being disciplined. Before your next investing decision, ask yourself this: am I doing this because my system calls for it or because something makes me feel less anxious? If it is the second one, you have found the illusion of control in your own portfolio. And noticing it, really noticing it, is already half the battle. The market does not reward activity, it rewards patience. The investor who mistakes movement for progress will always eventually pay the investor who understood the difference. We have now seen how the lizard brain fires, how cortisol hijacks long term thinking, and how the desperate need to feel in control turns anxiety into action, and action into cost. The question the series keeps asking is this: given that we all are wired this way, given that the biology is fixed, how do we invest intelligently anyway? That's the question we keep building toward, one topic at a time. See you in the next one.